Things just went from bad to worse for the stock market. The Atlanta Federal Reserve GDP Now tracker, which updates real data in real time to give us the most accurate estimate for the upcoming GDP report that you can find on the internet. This is from the Federal Reserve itself. We are now estimating a negative 2.1% GDP decline for Q2 2022. That would mean we are currently in a pretty deep technical recession, and this data will be confirmed to us on July 28th, the day after the Fed raises rates on July 27th. At the same time, you will have large companies such as Apple, Amazon, Google, Nvidia, Tesla, which report earnings during that same time period. So it looks like it could be a very, very eventful end of July, first half of August, and I want to talk about what kind of market dynamic we are going to be looking at over the next month or two, how that could eventually mark a bottom, and how we could start to retrace to the upside after we overshoot in a big way to the downside. So this is a video that you want to save and come back to later, because I am almost 100% confident in this information that will be expressed to you guys here in this video. Now, no, I am not a fortune teller. This is simply interpreting the data and giving it back to you guys in a clear and concise way that anyone can understand. So don't take this as financial advice, but it looks pretty obvious to me. And hey, before we dive into this video, it is the 4th of July weekend, so take some time with family, enjoy yourselves, and maybe even buy yourself a Budweiser cowboy hat. Thank you guys for tuning in, and let's get into this information. The Federal Reserve Bank of Atlanta is now expecting a negative 2.1% Q2 GDP print. Like I said in the intro of this video, this is the most precise and accurate estimate that you can get of upcoming GDP data, and this is from the Fed itself. And we pretty much fell off of a cliff. Not too long ago, we were actually in positive territory for the estimated Q2 GDP report. Now we are under 2% negative. So what is currently happening? Well, that is something we will talk about here in just 1 second, but I want you guys to look at the blue chip consensus. This is the range of the top and bottom 10 average forecasts, and nobody is expecting a negative print for Q2 GDP. This is why, or one reason why, this could upset the markets in a very big way coming on July 28th. Some of these top 10 estimates for Q2 GDP are even as high as a positive 4.5% print. Obviously, that is not going to happen, but what has made this estimate fall off of a cliff from a positive 0.3% estimated Q2 GDP print to start off last week, and by Friday you're sitting at a negative 2.1% GDP print? What has happened over the last week? The biggest data points that we got last week was personal income month over month for May and personal spending month over month for May. And you also did get on Friday ISM manufacturing PMI for June. Personal spending in the US edged up 0.2% month over month in May of 2022, the weakest gain so far this year, and following a downwardly revised 0.6% rise in April. Figures came below market forecasts of 0.4%. Spending rose for services, namely housing, international travel, and hospital services, and gasoline, while spending on motor vehicles and parts, namely new autos, declined. Real or inflation adjusted personal spending declined by 0.4%, the first drop so far this year, in a sign persistently high consumer prices starting to weigh on households' affordability. And that sums it up in a nutshell. And if you look at the chart, that's exactly what the chart is showing you as well. On top of that, last week there was also signs of slowing in the employment component of the ISM June manufacturing survey. The unemployment component fell for a third straight month to 47.3, a level under 50 signals contraction. So it's no surprise to everyone out there that we are likely in a recession. Now, the question then becomes, how deep, how long will this recession be? And investors will stop paying as much attention to inflation, because typically when you head into a recession, the price of oil falls, the price of food falls, the price of everything starts to fall, and you can actually experience deflation. That's why in the bond market, the bond yields have actually been dropping, because investors are more fearful about a recession rather than inflation. But once you actually head into a recession, people don't know how to value companies. It really starts to take a lot of time, a couple consecutive quarters at the very least, before people can say, hey, earnings are not going to fall off a cliff, this company is still growing. And that's when you kind of start to get more answers and where you can start to fairly value stocks. It's very hard to bid up a stock that is even doing well fundamentally when you are in a recession. And unfortunately, your $1 trillion plus companies control a vast majority of the weighting in the S&P, the NASDAQ, and the Dow. For an example, Apple in the S&P controls about 7% of the market weighting. Microsoft is another 5%. Amazon is another 3%. Google another 3%. Tesla is around 2% of the S&P 500 weighting. So depending on what happens with those companies could very well dictate what happens to the overall market. And those weightings are much higher for those same companies even in the NASDAQ. And that's why the NASDAQ is down about 30% for the worst first half of any year in 50 years. So we have definitely lived through a very tumultuous 2022 to say the least, but I do still think there is more downside to come when you factor in the line of events that we have for the end of July. Like I previously said, we have the Fed rate hike decision coming on July 27th. Then after that, you have the advanced estimates for Q2 GDP, the 28th, and it's very likely at this point that we are already in a technical Wall Street recession. And at the same time, you have major earnings mixed in here and there. And I think that is going to be very important and a potentially big fear catalyst for the broad markets. That is because earnings estimates may be too high. The equity market may be setting itself up for disappointment this summer. Earnings trends for the S&P 500 have been rising despite growing concerns of a U.S. recession due to the Fed tightening cycle. And you guys have seen this happening. Companies are starting to lay people off. They're not hiring as fast, and you're even seeing some major companies like Revlon going out of business completely. You have seen lots of data showing consumers are slowing down, that a recession is here, yet analysts refuse to downgrade their earnings expectations for the stock market. So the stock market's falling so much right now because of a recession, because of these factors, but they're not actually falling yet because people expect less revenue and less earnings at these top companies. But when that happens, when these earnings come in really bad, that's when you could get a topple over effect in the broad markets. But the big question is, how low is the stock market going to go, and when are we finally going to hit those lows so that we can start our long road to recovery back to the upside? And when we look at the margin debt, I like to look at this because it kind of gives you a gauge into how overall portfolios are looking. And we would expect to have seen the margin debt drop a lot more from the high of February 2022 at $835 billion to May at $753 billion. It has not fallen all too much, only about 15%, give or take, relative to the NASDAQ being down 30%, tells me that with another 5 to 10, 15% move to the downside in the NASDAQ, you could start to see some margin calls in a pretty big way. So now I want to take a look at the S&P 500 and go over kind of my levels that I am watching for currently, because I think it's pretty clear to see right now. And from my perspective, obviously you are in a very negative downtrend, and I think the real level that we will have to test is around 330 on the S&P. That would put us at our pre-COVID highs, but potentially we could overshoot a little bit further to the downside, and we will probably end up in between 300 and 330 on the S&P. In my opinion, end of July throughout August, I think that's the time period that we are really going to find a bottom after the markets overshoot and people start to reevaluate and say, hey, potentially this is not going to be a Great Depression, and a lot of these stocks are already at bargain discounts. But if you get the blue chip stocks, your Apples, Microsofts, Googles, Amazons, that come down to bargain territory, I think people will start to buy up those stocks in between that 300 and 330 level on the S&P 500. So yes, I do think you are closer to a bottom than to a top. And if we look at how far as on a percentage basis 300 on the S&P would be from here, that's another about 21% decline. I think at the very minimum, you're looking at another 13.5% move to the downside before we find a bottom. Like I said, end of July, probably more likely mid-August, but it could be throughout any time in August, and then you can start to make and move back to the upside, and you can get on this long road back to recovery. And then what's going to be most important from there is going to be company fundamentals, and specifically those companies that I have mentioned here in this video, because they control a vast weighting of the S&P and the NASDAQ. So those are my thoughts on the current state of the markets. I think we're one big event away from a flush out, and I do think it will be due to earnings. It will be due to a recession, inflation staying stubbornly high, and the Fed raising rates essentially to oblivion. So leave your thoughts down below in the comment section. Like the video, subscribe to the channel if you guys found value out of this video. I think this is a good one to save, come back and watch later in the month, possibly before we get to that next Fed rate hike, July 27th. So thank you guys for watching, and I will see you in the next one.